Hello active traders, and welcome to How to Improve Your Trading Quick Success Tips with my longtime colleague Rob Booker. I'm Ken Calhoun. Great to see all of you here. We had a really big turnout with over 600 of you. This is called Social Proof. We got over 600 of you registered for tonight's event, so thanks so much for making it a hit. And Rob Booker, it's a real honor to have you with us here tonight.
Hey, thanks. Good to be here.
I'm a big fan of Rob's. He's got one of my top 3 favorite YouTube channels in the world. He's got the traderspodcast.com, and he's one of the best guys out there to learn from. So really looking forward to seeing what Rob has for us tonight. Rob will go the first 30 minutes, and then I'll pick up the last 30 minutes. As always, all information is for educational use only. We're not making advice about to buy, sell, hold, no balance. You agree to not make actual trades. Bet $1 for every time I said that, I'd have a few $1,000s. I'm not just a long-term admirer and fan, but here's proof. I bought Rob's book, which is outstanding, over 10 years ago. So I've been following Rob since the dawn of time, and he's one of the world's top trading industry experts. Let's see. What else can I say about Rob? We've got an outstanding introduction here. Rob Booker is a well-known currency trader, educator, and host of the Traders Podcast. He started currency trading in 1999. That's when I started trading, too, back in the day. That same year, and his methods, ideas, and knack for teaching others has helped him shape the growth of online Forex trading. His 2007 book, Adventures of a Currency Trader, has influenced a generation of traders who aspire to trade for a living. And be sure to watch his YouTube channel. Rob has held senior positions in brokerage firms, but his true love and calling is trading currency and teaching his approach. And not just for currency traders either, too. I trade currency, but mostly I trade stocks. And I pick up and learn a lot from Rob's YouTube videos and his podcast. He's got lots of outstanding insights that are valuable no matter what instrument category you trade. He's a prolific, hundreds and hundreds of podcasts and YouTube videos on the subject of trading. He's one of the good guys in the industry. He's spoken at countless trading conferences, and I really look forward to hearing Rob. So let me turn it over to you and Rob Booker. It's a real honor. I've been wanting to work with you for years, so it's a real privilege to share this stage for the first time. And we'll turn it over to Rob for the next half hour.
Well, the pleasure is all mine. I am super excited to be here. Ken, let me know if you can see my chart.
Yep.
I can. Okay. Excellent. All right. So I always have a choice here when I'm doing a presentation to do it sort of brand new stuff, all new stuff, kind of from scratch off the top of my head, or I can do the same old boring prepared presentation. And I'm not even going to leave it up to you guys. I'm just going to do it not off the top of my head, but extemporaneously, because I love Ken. Ken and I go way back, and a lot of mutual admiration society stuff going on between the two of us. And it's an honor for me to be here. I want to thank Ken and thank all of you for coming out. And sort of because I like to hang out with Ken and we've known each other for a long time, I'm not going to give the same old canned presentation. I'm going to just sort of tell you what I'm doing now and share with you some stories about what has worked incredibly well. So with that as the introduction, I'm going to draw a little bit on my screen tonight. I'm going to share with you some thoughts about what's worked really well. And this means I'm going to talk off the top of my head. We're going to discuss a little trading system. I'm going to show you what's kind of working best for me. I'm going to give you a link to get some free stuff. And I don't care if you buy anything from me. It's not going to change my standard of living. It's not the most important reason that I'm here. I just love traders. I love hanging out, and I love talking about being successful. And what I want to do is I want to tell you, maybe weave in some stories of successful traders as we talk tonight and share with you some things that have really made a difference for me and for the other people that I've done, trading and work with and whatever else. Okay. Once upon a time, back in the old days, or whatever you want to call it, back in the day, let's see here if I can pull this up. I think I got this. Oh, I do. Yeah, this is working. Okay, so back in the old days, I started trading in the year 2000. Many of you already know this. Some of you are here, my friends. It's nice to see you all. I was $150,000 in debt. I had a failed business. And I was just a big dummy. And I turned to trading to get myself out of the mess. And I did a really, really bad job of that at first. And I lost my entire first account. I lost $2,500 in about 72 hours. And I was disappointed with myself, and I was depressed, and I was unhappy. And I'm going to come back to this story in a minute. And I want to share with you what made a big difference for me. And I want to say it again. It's not a sales pitch. I'm not here to sell you something or make you buy something. I'm gonna weave technical analysis and psychology and some principles for success into this presentation, and I hope that makes a difference for you. Let me share with you a little bit about how I do things and where I ended up and where I am now. And that's going to allow me to go back and tell you the rest of the story. But if I keep telling you a story, you're going to wonder why you're here and why we're not talking about technical analysis and why I'm not teaching you a system. So I'm going to go ahead and I'm going to teach you a method, and I'm going to share with you some details on what I do. On the chart in front of us right now are all of the elements that go into a trading strategy that I do right now, and that is the centerpiece of everything that I do. On the screen right here is, number one, this is a divergence indicator. I'm going to share with you how that indicator is built, and I'm going to give you a link to get that indicator for free on my website. That's number one. Number two are pivot points. And you can see in green on my chart, weekly pivot points. All right, so those are all of the elements that I use and that go into making trades in my own trading account, in my trade copy service, on my YouTube channel where I show my live account and I show all the stupid mistakes that I'm making and everything else. Now, I break just about every rule that you can read in a trading book or in a handbook of trading, or I break all the rules. I do everything wrong. I make all the mistakes that you think you're supposed to not make or whatever. And I'm going to share those with you, but I'm going to be totally honest that if you disagree with me, that's fine. I'm going to share with you what I really do and what I've been doing for 18 years. And if you disagree with me, I have all the respect in the world for you. If Ken does it a different way, I have all the respect in the world for Ken. There are a lot of ways to get this done. So I never mean to act like I'm some know-it-all, windbag, blowhard, trader guy that thinks he's the best ever. I've made all the mistakes. I'm just going to share with you the way that I do it. And I think you're fine with that. I don't think you're going to get upset if I just share with you what I really do. But this can upset some people. And so I just want to prepare you for that in advance. And I want to let you know that it's not everybody's cup of tea. All right. With that said, here's what I do. And then I'm going to go back and tell you my story. And I'm going to give you some context. I watch for this divergence, which I'm going to give you this indicator, and it's free, and there's not an obligation, and I have it for like 9 charting platforms. So whatever charting you use, TradeStation, eSignal, NinjaTrader, Sierra Charts, MetaTrader, whatever, I've got the indicator built. I even have it built for Thinkorswim, and they have the worst charts ever, like the worst garbage charts of all time. They have them. But anyway, so here's what I do. I look for a buy trade when there is this divergence indicator that shows up. And this is my indicator that I built. I call it Knoxville Divergence. Knoxville Divergence. And that shows a buy trade, and it's a suggestion, not a guarantee, but it's a suggestion that price is going to reverse and head upwards. And of course, in this chart example, it is going upward, and there are plenty of examples where it doesn't go up right away. And what price does is it is attracted to or drawn to these magnetic levels, which I referred to earlier, which is a pivot point. Now, many of you are already realizing what I'm doing here, and many of you are already reaching the conclusion that I'm a counter trend trader. And I'm not going to disagree with that. That's fine. I'm happy to be called whatever it is you want to call me. I don't really love the labels counter trend or trend trader, because a buy trade here, it may be a buy trade with a longer term trend, a weekly trend. It could be a buy trade against a longer term trend. I don't really care. I don't get into those. I'm just here to make money. I'm not here to get into arguments about trend trading versus counter trend trading. The other thing that I do is I take extraordinarily small positions. When I'm trading a stock, I might trade 10 shares, or I might allocate only 1% of my total available trading capital to the first position that I take. If I'm trading FX, I might trade 1 micro lot or 1 mini lot per $10,000 in my account. Now on my YouTube channel and everywhere else, I show multiple live accounts. I'm not here just talking about this theoretically. I do a trade copy service for my members, so my live trades are copied over. Been doing this for a long time. It's not to brag. I don't even care. I'm just telling you that I'm not just making this stuff off the top of my head. And I trade really small, and then what I do is I build a position. And if that position loses 1 to 2 to 3% of my total account balance, I close it out, I stop out the trade, and I start over, and I do it all over again. So I'm going to walk you back through what this looks like again, and we'll just pull up a different chart. We'll pull up like Australian dollar, Canadian dollar, because it's such a great, highly correlated. These two currencies are really highly correlated with each other. Okay, so here we go. Get my drawing tools back. I don't want to leave this. I just want to draw on the screen. Sure, whatever. Here we go. So we get right here, we have bullish Knoxville divergence. It's my divergence indicator, and it suggests a buy right here. There's 2 of them. And then we have these magnetic levels above price, and price is drawn to these magnetic levels. So I'll take a buy trade here, and I'll let the trade go against me. Now I'm breaking another rule. I keep my losing trades open, and I might have open losses. Now remember what I said earlier, I'm going to stop everything out at 2 to 3%. I'll have a stop loss on the trade, but I'm going to build a position. I might take 1 position here and 2 positions here and wait till the swing comes back up, and I might let that trade be a loss for a little while. And here's why I say that I do it that way. Let's go back and go back to my story. So when I first started out in trading, I did what everybody told me. I stopped out quickly, real quickly, tight stop losses. And here's what I did. I had terrible losing streaks. And I would stop out of a trade, and then it would just go in the same direction that I thought it was going to go originally. And number 2, I placed too much importance on winning, picking a direction and calling myself a high probability trader. And I got really caught up in these authors of these books that claimed to teach high probability systems and claimed that you had to cut your losses and let your profits run, and all these things, and those are fine. Those are great. I'm sure there's lots of different ways to get here, and I don't want to be argumentative, and I want to be respectful. I tend to go on a rant, but this isn't my webinar room, and I'm not going to turn this into a giant thing. I'm just going to say, everybody told me to cut my losses and let my profits run, and I just kept failing at making any money from this. I kept stopping out, and I kept having these losing streaks, and I kept getting super frustrated, and I was right. And what I realized is the market isn't precise enough, or wasn't precise enough, for me just to keep taking positions and have them just magically be high probability. I wasn't a precision trader. Maybe other people are. That's great. Fine with that. I'm happy for anybody that is, but I wasn't, and I was getting super frustrated. So what I started to do was I started to build positions. And I used to trade smaller on the first position so I could keep it open longer. So I could be, and I was really good at being wrong. I was really, really good at my first trade, or maybe even my second trade, being wrong at first, but I was right overall. I did pick the direction correctly. I just needed to give it some breathing room. And so I still have a stop loss. Remember, I'm not letting losses stay open forever, any business like that. That's not what I'm talking about. What I realized is that that if I allowed myself the chance to build a position, that mean reversion was a real thing. That a bank trader, who's a salesperson really, has an inventory or builds positions. If you work at a bank and you're a trader, you build positions. You inventory or hold on to trades, and then you offload them to other people. And that's exactly what's going on over and over and over again. And I realized that I could, if I gave myself enough time and space, I'd be okay. So what I do, and what I started to do, is I would take smaller positions, give myself time and space, and my positions would eventually work out. This to me was a really big deal, and I'm not trying to call it something that it's not. I'm not trying to make it sound like it's better than what it really is. This was a revolution to me. This is what allowed me to manage money as a commodities trading advisor for years. It's what allowed me to pull myself out of the rut. It's what allowed me to pay off my debt and get myself into a better position financially. It's what led to the publishing of my book. These two concepts made all the difference in the world. And so what I do now is I build positions and I hold them open. And if I'm wrong initially, I don't have this weird rule that I have to stop out immediately. I can take a sell trade when I get my divergence up here, and I can build a position. Even if it goes up against me, I can stay in the position. And as it drops, I can target lower and lower levels that are represented by these pivot points. This, once again, I'm going to give you the indicator for your charts so you don't have to worry about it. I just kept doing this over and over and over again. So let me see here if I can pull up the Australian dollar, Canadian dollar again, and then we're going to get to another concept that made a real difference for me. So I want to look for another divergence. So here's another couple examples of divergence, and I want to show them to you right here. So here are a couple more examples. These are bullish divergences. And look at number 1 right there. That prints a divergence, and that represents a buy trade, but it fails. But because I'm building a position, and because I have a really small first position size, that doesn't matter. And then I can get another one, number 2, a second divergence, and I can buy again. And I haven't exhausted my trading capital. I haven't taken a 2 or 3% loss. My position size is really small. And as the trade starts to move in my favor, I can add to what is working. And this was a major, major revelation to me. This was another really big concept. Think of, for example, I'm no expert on marriage. I was married last year, so please don't think I'm not an expert. I don't think I'm the greatest person ever. But a marriage is accepting flaws and adding to what works. You don't cut a marriage off because somebody doesn't take the garbage out. That's not how things work. You don't quit your job because somebody leaves the cups out at the water cooler. Like, nothing in the world works on this, cut everything short immediately. Nothing, quitting all the time immediately is a terrible strategy for success. But determination is a strategy for success. And so is building something over time. Now I'm going to add another component to all of this, but so far that's what we have. We have a trading system that's built from divergence plus targets, which are pivots. That's what the targets are. That's what we have so far. Divergence plus targets plus pivots plus small size equals a really easygoing, simple to follow trading methodology that has made me a very happy and profitable trader. And sometimes I've still had problems. I've still made mistakes. It hasn't all just been great all the time. So like, let's not, I'm not trying to say that I've never made any mistakes or anything like that. Okay, so that's what I've done. Now, I love trading, as you can see here on the screen. I love trading from longer term charts when I do this for my discretionary trading. And this could be Tesla, it could be IBM, it could be a pharmaceutical stock, it could even be a penny stock, and it could be Forex. I do a lot of my trading in the world of Forex, but I do plenty of stock trading as well in my own account. Okay, so I'm going to answer the question about what time frame charts I like. I like definitely like the longer term charts. I just think it's a little bit easier to build a position over time. Once again, the bullish divergence, the divergence indicator, I'll show you where to get that in just a few moments. And then pivots. A lot of people ask, where do I get pivot points? So on every single standard charting platform, every single charting platform in the world has pivot points. And if your charting platform doesn't have them and are not freely available, then your charting platform is garbage. No, I'm just kidding. Then you just got to reach out to the people who built your charting platform and ask them where pivots are. You just look for pivot points. I'm gonna guess that all of you are, if you have the smarts to open up the webinar, you have the smarts to reach out to your charting platform provider and find pivot points, and I'm sure you'll be okay. I don't want to spend any more time on that because I want to get to one other concept that really made a big difference. And here's the concept: mean reversion, and or counter trend trading, or whatever you want to call what I'm doing here, works better on highly correlated financial instruments. One of the reason that you're seeing me do this on the Australian dollar, Canadian dollar, is that the Australians and the Canadians both pull stuff out of the ground, oil or rocks, and they have highly correlated economies. That means this is what the Australian dollar, Canadian dollar is going to do. It's going to go back and forth, back and forth, back and forth. It's going to do a great job of mean reversion. And something like the Canadian dollar, Japanese yen, which is not highly correlated. Okay, well, I mean, one of the examples on the screen in front of us works just fine. But something like the Japanese yen is going to trend for long periods of time and not do a lot of mean reversion. Although, as you can see here, the divergence indicator did a fine job. So I generally don't trade the Japanese yen on a mean reversion strategy because it's going to tend to trend in a single direction, and the Canadian economy and the Japanese economy are not highly correlated to each other. Although now that we've brought it up, maybe I'll go ahead and I'll just take a look at what the chart looks like. Maybe we'll pull this up and we'll just take a look and see what happens. Maybe we'll just take a look and see if divergences work okay. I don't want to do any like these weird, well-placed examples that some people will do. So let's look at the Canadian dollar. Okay, so those are bullish divergences that lead to a buy or suggest a buy. And then it drops a little bit further, but then it does do a nice job of rising upward after. Here's some bearish divergences that would suggest a sell. Then price moves against us and then drops. Here's an example of bullish divergences. They both kind of pop up nicely right afterwards. All right, so one common question that I get when I teach this kind of stuff is, where do I place my stop? So my answer to this is as wide as possible, knowing that you have to close your position when you've lost 2 to 3%. Now, if you have a smaller trading account and you want to grow your capital, maybe you will allow yourself a bigger loss. Maybe, because you're going to be more aggressive. You do whatever you want. But I want to give myself 100, 200, 300. pips in the FX market, I want to give myself a really, really wide stop loss on position number 1 so that I can just tolerate, okay, I'm wrong, didn't work. Position number 1 is like a tester position. I just put it out there, and then maybe it doesn't work great. And then if price begins to move in my favor, I can add more positions as it approaches a pivot point. So this one is a buy trade right here. And let's say that it moves against me. Well, so what? So what? I don't care. I don't care that it moves against me. And because it's from a 4-hour chart, I can check on it, go away for 12 hours, come back, and now it's moving in my favor. I could put another position on. Now it's moving in my favor. I could put another position on. Moving in my favor, put another position on. And when it reaches a recent pivot area, I can exit the whole position. And this is an unsatisfying answer to the big question of how do you make money as a trader? And here's the unsatisfying answer that I tell everybody. Learn to build positions. Learn to do that. Learn to do it. Take the time necessary. Don't just depend on me. Don't just depend on one person. Learn a little bit from me. Learn a little bit from Ken. Learn a little bit from somebody else, and learn to build positions. Learn to accept that you're going to be wrong. Give yourself some space. Take a deep breath. Don't stop out too quickly. Don't keep taking large position sizes. The fastest way to get better as a trader, really fast, the fastest way to get better as a trader immediately, and it works every single time, is reduce your position size. It's the fastest way to get better as a trader. It's unenjoyable. It means you're going to grow your account more slowly, but it's the truth. Okay, where do you get the indicator, and how can we stay in touch? There's a couple things you can do. Number one, you can send me a text message anytime, and this will go to my real phone. This is really going to go to my phone. That is, I'm holding it in my hand right now. You can send me a text message. Do not phone call me. If you call me on the phone, an angel will lose its wings. Like a baby angel will fall from the sky. Like, do not call me. I hate phone calls, but this is really me. And you can send me a text and say, hey, I was at the webinar and I had a good time. And how you doing? Okay, so that's number one. You can text me anytime. Number two, to get the indicator, let me give you a link that you can go to. Let's go to my home page, robbooker.com. So go there, come along for a ride with me. Grab the indicator, jump on over to the website, and here's what you're going to see when you get over to the website. You're going to see a link at the top right here, free indicator. So that's where you get the free indicator. You put your email address in, and they'll send you instructions and a little class on how to get it set up on your charts. You can also register for this presentation, which is a 18-minute presentation with stories of the most successful traders that I've taught, and a series of stories about 61 people that I taught to reach between $100 and $500 a day in their trading. You could watch that presentation for free as well. You can get the indicator up there, and all you do is you go to robbooker.com. I love you all. Thank you, Ken, for having me here. It's been a pleasure. I hope you had a good time, everybody. And I'll see you around. Ken, look forward to doing more work together.
Absolutely. I'm a huge fan of yours. And everybody, I highly recommend Rob Booker. He's honestly one of the best guys out there to learn from. I personally learn a lot from his YouTube videos. Like I told him at the Traders Expo back in November, I feel like I know him personally because he's such a down-to-earth. I could listen to Rob Booker all day long. He's a friendly, nice guy, and he knows what he's talking about. And he's got a lot of real money experience. So thanks, Rob. You're one of the best people out there in the industry. So thanks for doing it right, man.
Well, thank you so much. And you do know me personally, and it's fantastic. It's great to be here. Thanks, everybody. Thanks again, Ken.
Yeah, thanks. You guys absolutely should. Rob's YouTube channel is one of my top 3 favorites in the whole trading industry that I follow. So be sure to, and his Traders podcast, he does lots of podcasts. Get the Knoxville Indicator. Do business with Rob. He's one of the good guys. So thanks, Rob, for being here, and absolutely look forward to working with you in the future as well. Thanks for doing it.
Yeah, me too.
You're a good
Thanks, Ken.
man, for doing it the right way.
Thanks a lot.
All right. Well, I could listen to Rob all day long. He's one of the few educators I could actually be thrilled actually listening to all day long and learn new things from. So that's high praise because I don't say that very often. Anyway, welcome everybody. We're going to look at Forex and stock charts today. I want to give you some good examples of the types of charts I like to trade. Rob is absolutely right. I like trades that you could build a position in. I do a lot of position sizing, and I trade charts with consistent uptrends like this. I trade both Forex and stocks, though I'm primarily a stock trader. We're going to look at some chart patterns here. Mean reversion, in case you're wondering, you may have seen my stocks and commodities article. It's something where something makes a big honk and move up. It does a 50% pullback, and then it continues its merry way on upwards. This is what I call a Schwang chart. A good technical indicator thanks to Wayne's World. Schwang. Anyway, party on. Let's take a look at some excellent charts. I want to give you some strategies tonight to learn from, and I wanted to thank all of you for being here. I've only got a single PowerPoint slide because I kind of hate PowerPoints, but I realize that they do help. These are the things I'm going to cover using live chart examples. Rob said, and he's exactly right, it's my number one thing is what I call trade wide, not deep. I know another colleague of mine, Tom Sosnoff from Tasty Trade, says trade small, trade often. And we all say the same things. Trade many different instruments, don't trade large position size. You know, for me, for example, if I'm trading equities, I will start off like Rob. I may do 10 or 20. Look at these. Here's a day, real money trades, where I made $850. Here's a screen cap of my Real Money Interactive Brokers account. And look, I got as small, talk about small, it's 2. When I'm wrong small. When I'm large, it all adds up. You know, it's like $800 the hard way, right? A lot of traders overtrade, they over leverage. It makes a lot more sense to trade light size. We're going to be looking at those strategies and more illustrated with real money examples. But before we get underway, let me introduce myself. You may have seen me in CBS Market Watch, TheStreet.com, blah, 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 blah. I'm not going to read all this. You may have seen my articles every single month in Stocks and Commodities, the Trading on Momentum column. You may have seen me back when dinosaurs roamed the earth in 2001 in CBS Market Watch. I founded the original Day Trading University, now Trade Mastery, because over half my traders are swing traders. So you may have seen me at the expos. I prove I really trade. There's my tax return, $5 million, $4.9 million worth of real money trades profitably traded in a single year. So I'm the real deal too. Anyway, so that's what we're going to work off tonight is this quick list, and I wanted to give you some insights in terms of how to do this the right way. If I were to say two things, it's I still like using tight stops. The trick is you need to use really strong charts, and the equity charts I follow tend to have especially strong breakouts. But the main thing is trade wide, not deep. Trade exactly what Rob said. I completely agree. Trade small size. It is so much smarter to trade 10 positions of, say, 100 shares each than one trade of 1,000 shares. It diversifies, so you're giving yourself many chances to get it right. Combine a tight stop, not too tight where you get stopped out. I'll show you how to do that with strong charts, gaps, and clean breakouts. Avoid false breakouts. Here's a quote. Trading is a lot more about the math than the chart patterns, okay? And that's very true. Trading is a lot more about using your unrealized P&L to manage your exit, because far too many traders trade large size and then they get in trouble. It's much more important to get out when the money's there before it goes against you, and feed the winners, starve the losers, find your edge, focus, and win. So let's use that as kind of the outline for some specific patterns to look at. Today's stock market sold off like a son of a gun. So I'm currently long VXX, which did something like this. Now, the first tip is make sure that you trade markets first and stock charts second. We'll also look at some Forex examples later, but I want to start off with equities. We lost the 100 simple moving average in the spiders. This is the S&P, the SPX chart. We lost the 100 simple moving average today and started to go back down inside this trading channel. So that's a short pattern. What you don't do as a trader is just sit on your hands and watch the market go down without you. What I like to do and why I'm trading, I position size and have for years charts like UVXY, the VIX ETNs, or the other inverse ETFs that move up sharply when the stock market sells off. But this is my favorite one, VXX. Today, we have an inverse head and shoulders right here with the neckline right over whole number. I like to buy right over whole numbers as a core strategy. And I ran all the way from a base of 35 support up to 39.5 resistance. So it's a 4.5 point run. So that's a really good chart to follow for upcoming. If the stock market continues to sell off, I wanted to give you some fish in addition to teaching you how to fish. Whenever you have an instrument that recovers over one of the major moving average lines, like a 200 SMA or 100 or 50, that often makes for a good institutional long signal. Look at the volume today. It was 55 to 60 million shares today, right? It's almost double the previous volume. That means institutional buying and short covering. A short squeeze actually is probably what today was, a short squeeze that may attract additional buyers. So do keep an eye on VXX in case the stock market sells off. But the first tip is make sure you're trading charts with good directional bias and volatility that have enough trading range. This is what I mean by stronger charts, gaps and clean breakouts. Gaps will often continue, and I like trading gap continuations. We'll also look at Forex charts in a minute too, but I wanted to start off with equity charts that are especially great because trading successfully, I found, starts kind of like playing poker or getting married. You want to start off with a good starting hand or a great partner who's honest and has good family values and all that kind of stuff. For marriage and for trades, you want charts that have good directional volatility that makes sense. The main thing I found is most important for successful trades in terms of chart selection is not so much just the underlying long pattern, but the range. And a lot of people don't learn that. They'll overtrade choppy, horrible charts like, let's pick on Microsoft. Really stupid chart to trade. Why on earth would anybody in the world trade a chart that's $95 a flipping share, 90 bucks, almost $100 a share, and has only 10 points of range, when, I don't know, you could trade a chart like this. I don't like penny stocks or overly cheap stocks because they tend to pop and drop and they aren't consistent. You want charts like this. This guy has a multiple of Microsoft's range for less than half the price. And it's got a gap continuation pattern. So one of the rider downers or one of the core learning points is make sure that you trade charts with sufficient volatility on volume that's reasonably strong and has a good upward projection. From a scaling in standpoint, or how to position size, as my colleague Van Tharp would call it, I always like tight channel. This is one of the quick rider downers. Give preference to charts where you could have, if you had a time machine like a DeLorean or the fellow Whovians out there, TARDIS, time and relative dimension and space, you could go back in time with the doctor. Well, you could throw darts at this guy all day long and build a position over time. And Rob Booker is absolutely correct, and so am I and anybody else who's a professional. Well, we know these kind of things. You want to build positions by, the way that I do that is pick charts with the best trading odds that have really tight breakout patterns and enough point range to make it worthwhile. Even if I'm only trading, 20 shares or 50 shares and I build it over time, you're not going to find this kind of strength in a chart pattern that's a, $5 stock. If you're fortunate, you'll find one that's like this one down at $15 a share. This is a freaking quadrupler, right? It went from 4 to 16. How would you have known that this was going to do this? This is that mean reversion pattern. It went from 4 to 1750. One of the key patterns that I've taught traders for many years that was copied by other educators is look for large green candles at the right side of bullish cups, especially if you have a sequence of multiple green candle days, 3 or 4 or 5 days in a row. If you see a large green candle, especially this particular pattern, does everybody see this where you got a small candle here followed by a larger candle that's twice the whole real body height? That particular pattern is especially good for a volatile breakout. When you see small followed by large, kind of like baby bear, papa bear, you see small, large candle, especially if that breaks previous resistance, that often makes sense for breakouts. So even if you got in long at 6.5 or 7, you'd be happy as can be, right? Because this guy ran all the way up to 16. Another key to success in trading millions of dollars worth of stocks with, I don't know, little proof that I had profitable year trading 4.9 million worth of stocks. That's my heaviest year. A lot of coffee. That's another success tip. Caffeine is your friend as a trader within reason. But the point is, at least for me, it's been one thing that I found in trading millions of dollars worth of stocks in a single year to test out patterns, which I do for all of my subscribers at my Trade Mastery subscription services, is it all starts with strong previous trending charts. You have to, with tight trading ranges and enough volatility to make the profit potential reasonably good. I mean, do the math on this. Now, I like swing trading and building positions for longer term charts, primarily in equity charts, because I don't see that kind of consistency in the Forex charts. Forex charts I found for swing trading are usually good for 3 to 5 day, at most, 3 to 5 day round trip scalps. If you look at, say, some of these different FX charts, this is a 90-day daily chart. The euro dollar crashes and burns. Boom. Stop the madness. There's got to be a better way. The euro yen, also crashing and burning. The euro CAD, also down in the dumps. The dollar yen's been the only recent strong gainer, and even that gave back a lot. We had a shooting star here, and bang, flawless victory, to the downside at least. So when you do trade charts, what you want is to trade. I don't trade pivots, I trade breakouts. I'm a breakout trader. And you know, your mileage might vary. I prefer to buy high and sell higher. One of the quick exit signals, if you do not see a classic candle reversal pattern, as taught by my colleague Steve Nissen, the correct person and only person to learn candles from. Steve Nissen at candlecharts.com, my longtime colleague. Anyway, if you don't see a shooting star or bearish engulfment at a top, what I use as a surrogate, and this is a rider downer, especially good for Forex traders or currency traders, is if you see 2 red candle days in a row. A loss of support of 2 red days in a row is often a break in the trend. So if you bought the initial breakout, which is a cup pattern, right, if you bought that initial breakout into the range above this moving average line, and it continues on up, when you see 2 red sequential candles and it loses support, game over. And it's a good time to close out the trade, book your profit, and be done with it. You can always rebuy new highs if it takes those out. Another quick tip, make sure to use at least a 30 pip safety buffer above highs. A complete moron, a fool, I shouldn't rag on the retail traders, but a less sophisticated trader always buys the obvious breakout. Do not do that because you get stopped out. It's frustrating as heck to buy, well, I thought it was going up, and then you get stopped. How many people, whenever I do my money show and the money show events or the traders webinars and seminars and all the rest of it, I would say, how many of you does this sound familiar to you? You bought a breakout because it looked good. Directionally, you're correct, but it stopped you out, and then it ran up, 200 pips without you. Very frustrating. So do not buy the obvious dumb money retail breakout above resistance. The trick to breakout trading is use what I call a safety buffer, usually 20 to 30 pips above the obvious resistance level, or for stock traders, 50 cents or so above the obvious high. For example, this chart, I wouldn't buy I until it breaks north of 18. I wouldn't be buying 1750. It took me many thousands of trades to learn that the hard way, and a couple of blown trading accounts. I didn't start turning the corner as a trader till I realized how to combine strong charts with very careful stops, with multiple positions, and position sizing or scaling, or building trades over time, building positions over time. So the only chart in this whole gang is the dollar yen, and even that's kind of selling down lately. So if you're a Forex trader, make sure you're trading the right direction and the right types of charts with the right volatility. Anyway, do you see how much money you could have made trading this chart? It's to avoid, again, it's really, you would never ever day trade stocks under $10. That's for complete morons and college kids and people who pretend to be day traders who aren't. There's a lot of them out there. So watch out for the hucksters who are mostly young guys under 40 who don't know what they're doing, who are in grade school, and I started day trading back in '99, and they advocate low float under $10 crappy $4 stocks or whatever is a way to day trade. You don't want to do that. What you want to do is trade stocks with say $20, $30, $40 a share with at least a 1 or 2 point trading range. And if you're swing trading, you want charts that go a little something like this. If you're trading cheap charts, this one would make sense too. Like not right now because it's a bearish engulfment. It's likely to drop now. But it had been quite the runner. TNDM, the ticker, this guy ran from 4 to 14. Very much like this chart where it ran from 4 to 16 or 17. The most important pattern is consistency of trend. And one of my favorites that I speak on regularly at the Money Show Traders Expo events and at my online events as well is a acceleration ramp. And I don't have any special indicator for that. I like you to do your own thinking with your eyes, and your brain is the best indicator to use. Looks like a hockey stick pattern. You got a steady uptrend, then it angles up to a sharper angle breakout. Okay, now it's pulling back, so we don't want to go long here. I wait until 50 cents above the nearest whole number high is kind of a default go-to pattern for continuation. So the earliest I would buy this guy would be 1550. I'd be kind of skeptical. The old me would have bought, say, 1470 or something, because I don't want to miss out on the run. Then it'll run to 15, stall down to 13.5, stop me out, and then run to 18 without me, and really frustrate me. Lather, rinse, repeat. Fast forward 15 years, and I learned the difference. Put a safety buffer, a false breakout filter that the dumb money or public money or retail traders would be getting in at, and don't trade there. Mentally, this is a very important writer downer, so it took me thousands of real money trades to figure this stuff out. You should always be kind of drawing a little X. X marks the spot not to trade that's right above resistance. Because how many of you have done this, where you've gotten into a trade where it looks like it was, well, it broke resistance, so that's why I got in. Thanks for playing, Sparky. Johnny, tell them what they want. You got rice-a-roni and floor wax. You lose, Sparky. You don't want to trade right above resistance. What you want to do is trade at least 50 cents, maybe 80 cents, and even then on small size to build a trade. When it comes to position sizing or scaling, I like to look at it like I'm planting a lot of seeds in a garden and I'm watering them. That's what I've told thousands of traders over the years. You trade wide, not deep. So I may be trading all of these, maybe just 50 or 100 shares at a time. This guy's a pivot long, right, on today's sell-off. Right, all the inverses ran today. Leading the way is the VIX ETNs. Like TVIX, they're all the same exact chart, just different prices, which is the beauty of this approach. You can trade TVIX if you're, I don't know, broke and can only afford $6 share stocks, okay? UVXY is double that at 13, and VXX is my favorite as a professional up at 38 because the point range is more lucrative. But the point is you can lock and load and engage with, say, your VIX ETNs at several different price points depending on your capital allocation approach. What else? Lessons learned. Trade using your unrealized P&L. And let me see if I can get you an example of that in here. This thread at my Trading Talk forum has $140,000 views. So one of the most popular in the whole freaking trading industry because most of these are older examples because I got tired of updating it with screen caps. But I do have some recent ones as recent as, I don't know, February this year. I was going long in the inverse ETFs. I was up $2,000 in my Fidelity SEP. Schwang, or actually let's say ka-ching. Where's that sound effect? Ka-ching, up $2,000. Trading those guys that I just showed you the chart patterns for anyway. So I like to illustrate. I don't know how many of you agree. It's kind of nice to have, and I like transparency, examples from real money traders who actually really trade. Anyway, the point is trade with your unrealized P&L, right? So, you know, this is the unrealized P&L. This is a screen cap from my Interactive Brokers account, my live real money account from a couple of years back. But the point is your unrealized P&L is where the rubber hits the road as a trader. You should be spending more time on the exit side of your trades using unrealized P&L than you do simply on identifying magic chart patterns and where to enter. truth is, and it took me a lot of years to realize this with millions of dollars worth of trades, is in a strong chart, it doesn't really matter if you buy, say, 35.2 versus 35.8. If it's a strong trending chart and it's going to run to 40, who cares where exactly you get in? It's where you lock in profit and your exit that determines your success or failure as a trader. I advocate, and I speak on this in Money Show all the time, if you're up, say, $800 in a trade and it gets back down to $600 unrealized P&L, I take the money and run. I'll close out the trade, go to cash, book a profit, because I'm in it to get paid. I'm in it to make money. That's why I trade, specifically to make money. I love money. Greed is great. Greed is not good, as they said in the movie. Greed is great. You're not so much greed, but just the sweeping of money off the Wall Street casino, being the house, not being the rookie players, is the right way to do it. Point is, your unrealized P&L is live or die as a trader, and you should be spending a lot more time on that than you currently are, especially on your exits. They don't treat, none of the educators, or very few of the educators I know, teach how to use unrealized P&L exit strategies correctly, because many of them don't even actually trade. But it's important that you, so they can't, but you need to use your unrealized P&L as a core key indicator to manage your exits. Okay, there was an Aussie dollar in an FX trade. It's just a few minutes left, but the point is, manage your exits using your unrealized P&L. Let's say if I'm up, and I know you could use this too in swing trades. Let's say you're in a basket of stocks, and let's say you're in, say, 8 positions, and collectively maybe half of them are stopping out, the other half are winning. The wins are bigger than the stops, so you're up, say, I don't know, $800, $1,000. It's fine to go to cash in the whole rack of trades and close them all out at market to book a profit. Your goal should be much like gardening, which I don't do. That's what I hire people to do, but I've got a big 4,000 square foot house, which is kind of fun. But the point is, I don't have time to clean it or take care of the lawn. That's what I hire people to do. But the point is, as a trader, it's like being a gardener that clips leaves off of the plants, or out there at the apple tree, you're plucking apples out of the branches of the apple tree. As a trader, your goal is to take money with the unrealized P&L before the stock market or your FX market takes it back. So feed the winners, add to your winning trades. Rob said build positions. That's exactly correct. That's what I mean by this too. Add to your winning trades, subtract out. You don't have to go to cash in the entire position, but if your position's going against you, at least scale out of half of it for a smaller stop, and then let the rest of it ride with an even smaller continuation move. So add to your winning trades, subtract out of your losing trades. It all starts kind of like in poker with your starting hands. And if you have a 7-deuce offsuit, you're going to fold it. If you got pocket kings, maybe not. So anyway, make sure that you start your day off with charts that make sense, that are consistent. That's one thing that I teach traders around the world, is to spend more time identifying great charts. Now, that's what I do in my subscription services at TradeMastery.com. I offer 5 different subscription services for both Forex and stock traders. But the point is, if you're doing it yourself, you should be looking for charts that go a little something like this, right? With really good directional volatility, implied and historical volatility numbers that are strong. Look, excuse me, look for early breakout signals, like large green candles like this guy at the right side of a bullish cup pattern. By the way, you should use your candle patterns correctly. The correct walkthrough on this would have been long here and out right there, because that's a loss of the shooting star support, right? That's a shooting star. A loss of support would be the place to collapse the trade. The rebuy would be above the shooting star high, which I like because it's got a large green candle. Does everybody see that? Because we didn't know it, I mean, now we can see what happens, but this guy could have easily kind of drop back down again. So shooting star is bearish. So what you do is you go long above a key resistance area with a 50-cent or so safety buffer to keep you out of a false breakout. Let the trade work out. When you see a bearish pattern, like a shooting star or bearish engulfing, and it loses that support line, that's the place to get out of the trade. And then you wait patiently, and a week later it comes back, it's alive. Zzz, it's alive. Flawless victory. You go long, you shoot, you score, the crowd goes wild. Now, tight exits. Let's wrap up with a quick exit strategy. Where would you guys, the good traders will use tight stops, the bad traders not so much, especially with these kind of charts with big point ranges up and down. Leverage and volatility cuts both ways. The trick is trading charts with consistent uptrends. And again, this is a mean reverting pullback. It came up, it pulled back down to 50%, continued up. You can see more in mean reversions in my stocks and commodities articles at this technical analysis of stocks and commodities magazine. But where would you guys trail a stop? Let's say you're long and you're in the money, but we had a big red day in the stock market today, so you're correctly nervous long. Where would you trail a stop up here? Go ahead and type in. This is the part where you type in an answer. You guys are amazing. I appreciate all the comments. Where would you trail a stop? I'm seeing 14.8, 1475. Yeah, my traders got it right. Thanks, Mira Mukesh. 14 and a quarter, that's fine too. Somewhere north of 14. In the interest of time, I'll move on. But no further down than 14. Now, a bad trader, a sucky trader, would have bought, say, 9, have it go up and say, well, I got to give it some wiggle room, so let it come back down to where I got in. And thanks for playing. Your goal is profit extraction, not profit give back. It's profit taking. So if you're in somewhere here, somewhere between 14 and 15 makes sense to get out of Dodge, right? That's a loss of a 2-day support line. So somewhere in here is the right place to trail a stop and go to cash if it starts to drop. One of my favorite earlier trending charts that recently turned back down is WLL, right? It ran all the way from 30 to 54. It almost doubled, but it had a bearish engulfing. With a bearish engulfing candle pattern, we exit right there, right? If you're still in, the trailing stop would be, say, 46. That's where I'd give it to. But the point is, if you caught it, that would be the correct thing. So you could have built your position. Add a little more shares, another 50, 100 shares, another 50, 100, another 50, 100. So you build your trade over time, and then at the first sign of a bearish engulfment or a shooting star or a 2-day loss of support, it makes sense to get out of Dodge. So those are some of the types of charts that I like to work with. So thanks so much, folks, for being here. I am formerly Day Trading University, but since over half my traders are swing traders, I also own swingtradinguniversity.com, but instead of running all those flipping sites, I thought I'd put them under my Trade Mastery umbrella. You can join me every Saturday for free trading webinars at trademastery.com/free. I've been doing these for over 6 years. I first started doing Saturday webinars back in 2001. Back when dinosaurs roamed the earth. I'm the first guy who invented and developed not only university sites for traders, but the Saturday webinar concept back before there was a GoToWebinar back in the old days, but the days of yore. But anyway, I still do these every single Saturday. You get to get my top picks and strategies at trademastery.com. You can start with a click here. I've got lots of other resources. I've got courses, I've got alert services from our live chat room, I've got small cap scans, swing scans, chart scans, forexvideos.com, a lot of things there. Kind of cool video at the top, but start with by just, whenever I ask at the Money Show events, I say, how many of you agree that you should get some actionable, tips and strategies that actually help you make winning trades for free from an educator before you pay anything? And I think that's completely correct. And so feel free to join how many do we have? We're over 5,000 now. Over 5,000 strong. Actually, we just broke 5,200 last week. So number one in the whole trading industry for a reason. I've built this list carefully over time by adding good value. You can join me for my free weekly Saturday webinars at trademastery.com/free. I want to thank all of you for being here. It's my distinct pleasure and honor to work with people like Rob Booker and other people who are genuinely trying to help traders and know what they're talking about, and they're friendly and humble and honest and have good values, and Rob's certainly all that. So make sure that you learn from him, learn from me too, learn from a handful of us, and hopefully you'll start turning the corner And, hopefully you've seen some commonality in what both Rob and I taught you about scaling in, small initial size. Those are both core, and I completely agree. Those are two of the most important things to get right as a trader. Is far too many traders are trading 500 or 1,000 shares when they should be trading 50 or 20 shares. Far too many traders are trading 8 contracts instead of 1 or 2 contracts in their options trades. Or they're trading 4 to 8 standard lots instead of micro or mini lots. Trade small, trade carefully, and I wanted to wish you all the very best for success in your trades. I will be getting this posted up on my YouTube channel and get the GoToWebinar to email you the link so you can replay that at your leisure. And thanks for being here. I appreciate it. Traders asking, what does wide not deep mean? I just mean many positions, not one trade heavy share size, trade 5 or 6, positions, lighter share size. Makes sense. Well, thanks for the kind words. I appreciate that. Mike and Jerry and Dan and Michael, thanks. Thanks, everybody. Appreciate it. Hey, well, you guys take care, and I will see you guys in the live webinars. And be sure to subscribe to both Rob Booker and myself, our free services. We got a lot of content out there designed to help active traders. Rob's YouTube channel is great. Mine is pretty good, too. We've got lots of, my webinars are great, so be sure to sign up for those. And I'll see you guys on the other side. So until next time, trade with passion, trade with intelligence, trade with small size, and let's go get them. You guys have been an amazing audience. Thank you for being here, and it's great to see. What's our number? Our final number is still holding steady at 602. So we just broke 600 resistance. So thanks to the 600 of you for joining us. It's been a real honor and a real privilege. I'm Ken Calhoun from Trade Mastery. I run the plays. So thank you so much for being here. Take care and best wishes for success. Goodbye for now.